So let's just say it's $1.5 million. Your minimum down payment now will be $125,000.
Right.
But in order to get that mortgage,
you need like a $350,000 household income.
About $310,000. That's with little to no a debt.
Which is probably more than double the average.
Correct.
Hey everybody, welcome to episode 309 of the Real Estate Podcast. Today, Ariel and Adrian talk with Cameron Mackie of Dominion Lending about mortgages. Hope you all enjoy.
Welcome to the Real Estate Podcast, your go-to source for raw, unfiltered stories and expert tips. Whether you're a buyer, seller, tenant, landlord, or realtor, join us as we dive into the world of real estate.
Good morning, everybody.
Good morning.
This is an exciting day. We've got our first guest on the Real Estate Podcast in our new studio.
With the new studio, yeah.
So we're testing out all the cameras and hopefully it works well.
Beautiful spot.
Yeah. Welcome, Cameron.
Yes.
So I'll let you introduce yourself. But Cameron, we've known for, actually, I don't even know how long we've known you.
8 or 9 years.
The first time I met you, I was on a boat.
Mm-hmm.
I was on your boat.
Yeah.
In Lake Ontario. And you were whining and dining a bunch of people, having a good time. And
then you invited him.
The rest is history.
Yeah.
That was the next time. Absolutely.
Did we go on the boat again?
Good time. Yeah.
I don't remember the second time.
Well, you probably don't remember the first time.
Was I drinking?
I remember.
So yeah, Cam, if you could
much.
Introduce yourself to the audience.
Cameron Mackie. I've got a mortgage brokerage with up in Canada with Dominion Lending Centers currently. Down in the US, I've got a mortgage brokerage as well. So we do look at both sides of the border, and it gives us some pretty good predictions of how things are kind of going on because we can see what's happening in the US market compared to the Canadian market, and seem to be very similar in specific ways, but then very opposite in others. So it's been doing it for 18 years now. It's been a long time. So
that's a long time.
Yeah, almost 2 decades. It's crazy, but which is good because then a lot of the stuff we've found over the years, it actually repeats itself. Very similar. Like if you really look at the historical numbers,
like the industry is very cyclical in terms of ups and downs and how it's trending.
It doesn't reinvent itself. It's very similar year after year. Obviously thrown in, you've got a pandemic or whatever, it kind of throws things off, but very similar. If you look at statistics of, let's say every 8 to 10 years, you've got you spike in either rates or economic issues, all that kind of stuff. So it's interesting, but this one in particular is a little bit different than the others, but yeah, we'll see how it goes. Like 2025, I think is going to be an interesting year for sure.
Between the US and Canada, do you find like one is trailing the other? So you'll see changes in one before the other, and then it'll follow suit, or are they? In what ways are they similar or different?
So that is true. They do follow each other. Like when the Fed in the U.S. changes their rate, usually Canada will always have to follow. The only difference is because the average mortgage rate or term down in the U.S. is 30-year.
Right.
Here it's 5 years. So that truly, if you're a homeowner down in the U.S. and hey, rates are too high, you just sit put, nothing changes. But here, like I think 65% of Canadians are thinking are up for renewal in the next year to year and a half. So if you're going from 1.5%, 2% of a rate, and you're jumping up to 4 or 4.5%, that's.
And what's the average mortgage
for
dollar wise?
Dollar-wise, $350,000 right now.
Okay,
it depends on like Ontario, or if you're looking at Canada, it changes a lot.
But for the average person, that's a pretty significant jump.
Our Oakville location, where our average mortgage amount is about $635,000 right now. It's huge. So it's area to area, it's definitely different.
That's lower than I would have thought for Oakville, 635.
Yeah, it's been around there for about the last 4 years. It's as much as the values have jumped. Like really think of it, there's 50% of Canadians really only have a mortgage, but we think that's not the case. We think everybody has a mortgage, but That's why there's the value itself is, put it this way, a lot of the new home buyers, it's the bank of mom and dad that's giving them we're refinancing the parents' house to give them money now so they can get into home ownership. So that's why it keeps the mortgage amount as low. Well, it's not really low, but 630,000 is still hefty.
There's a ton of articles right now over the last month or so about the early inheritance that is kind of trickling down from the boomers to their kids and grandkids.
Yeah.
And the average right now is, I believe, $120,000 or so that is gifted to first-time home buyers. And it's like $180,000 gifted to people that already own a home and are upgrading.
Yeah.
So if they own a townhome, mom and dad give them $180,000 so they can afford to get a detached home or whatever. It's pretty significant if you think about it. Yeah, nice. I just want to actually jump ahead, Cam, because we made some notes on things we wanted to talk about today. And last minute, you threw in something else which kind of ties into what you just talked about mortgage switches, that they now qualify on the contract rate rather than the qualifying rate. So can you just elaborate on that?
So
that just came down the pipeline, right?
It just came out last week. And again, until it's fully announced, which is going to be November 21st. That's the next quarterly announcement through OFSFI. They're going to announce it, and everybody basically will follow the same guideline. Lenders currently are already setting up. They're working with lenders to launch this. So it's not like we're waiting until November 21st in order to actually have it fully launched. So it's currently active. You can work with it. The lenders have to obviously change their policy and their guidelines and everything in order to switch. Now, as much as it seems easy, yes, they still have some work to do. But what it is when you're up for renewal, you're going to have your mortgage. Normally what would happen is if you went from, say, you're on a 20-year amortization remaining on your mortgage and you're up for renewal, what do you do? Okay, if you want to call around for another rate, if lender B has a better rate than lender A, your current lender, you should be able to move. And yes, we usually, like, to our clients, they switch and it doesn't cost them anything. But the problem is they have to requalify at the new qualifying rate, which is way higher than when they initially got their mortgage 5 years ago. So it restricted a client from saying, hey, I want the best mortgage rate. And what lenders were doing is they were saying, I know that you had a hard time getting your mortgage the first time around when rates were lower. So what do? They jack up the rate. I've seen a lot of renewals where we can't actually move them because of qualification standards.
Because they got to go through the stress test.
Right, the stress test. It hurts a lot of customers. They can't go because they're stuck.
So there's a monopolization.
Correct. Yeah.
So it's like anti-competitive.
Right.
But not only, well, I mean, that's one component of it, but it is also even still going to take more work, because with the current lender, they don't have to provide, correct me if I'm wrong, but they wouldn't have to provide proof of income and all that stuff again. But with a new lender, they would have to go through the motions of a formal approval.
Yeah. So they do have to get approved with employment letter, pay stub, all that. The normal stuff is if you're attaining a new mortgage. But when it comes to
the numbers,
like, so realistically, so just as an understanding, the qualifying rate, let's say it's 4.5%, let's say the current rate as of today. So you wanted to move to the next lender. So you would have to qualify at 6.5% in order to make that switch.
Right.
So the new rules allow you to actually get approved on that switch at 4.5%. So it knocks off 2%. And 2% on a 20-year amortized loan, right? A switch is made for specifically, you're not touching the amortization. You're not touching basically anything. You're just going from one lender to a lender that has a better rate.
So as soon as let's say somebody did want to extend the amortization, would that revert back to having to qualify the higher rate?
Yeah, that's then you're into your standard refinance structure, and that's you're qualifying at the contract rate plus 2%.
Interesting.
Mm-hmm.
Well, we should see some more competition then if you're, and that's good. If 65% of the country is up for renewal in the next 18 months, then that gives them a little bit better negotiating rate with their current lenders, right? Or negotiating power with their current lender.
Yeah. I'm also trying to find out if we've got, like, because all the details have not come out yet, I will.
We need to have that, like when you go to the movies and they have the screen that says little animated video saying turn
Robbie,
off your
we're going to need
some
instructions for guests.
I thought I turned it off, but
or we should have a little bucket. We put our phones in a bucket.
I thought you were recording yourself because the way it's tilted towards you.
No, I got my notes just in case if I forget something.
Little cheat sheet. That's smart.
So what was I saying?
Well, on the topic of renewals, you had mentioned before we got started with the podcast, you had mentioned that October 31st is it all financial institutions year end?
Right.
Something like that?
So I saw your previous podcast and you're announcing that the banking sector, like the big banks, the big five, are really aggressive with rates right now. And that is true. Like most of our book right now on refinances and purchases are all going to the big banks. So because they're so aggressive. And the reason why they're so aggressive is because they have, it's their year end is actually October 31st. And there were a couple other regulations that they were supposed to pay, and I won't get into detail about it, but they had to allocate about 3% of their book in order to, with this new reg that was coming in, they had to basically put money towards it. The government backed down and said, no, you don't need any more, but the banks basically have this extra pool of funds, so what are they going to do with it? So now they're really pushing money out as much as they can. So if you can get a pre-approval now, between now and October 31st, great. You're probably going to get a really good rate. Our conventional rates, the big banks, they can't, no other monoline can really touch them right now. So it's just because it's their year end is ultimately what it is.
So if somebody's watching this and they have a mortgage coming up for renewal in the next several months, like at what point do you think it would be worth them pursuing a renewal earlier in order to get in before that time?
I would do it. It's 120 days for the rate hold, which is good. However, with the way the market's trending, even right now, they could actually decrease. Still, the rates could still decrease naturally. But and then, of course, as long as you lock in, you know that you've got the really good rate.
Right.
And if rates don't decrease, at least you switch at that time. So
there were some changes for first-time home buyers and new home construction buyers. We chatted about that a couple of podcasts ago. How do you think now with the $1.5 million cap on insured mortgages and the extended amortization for first-time buyers, new home buyers, do you think that's going to play a big effect on the market?
I personally think it's a little bit more of a political stunt, but I don't think it's going to have a large effect. As much as it is still going to move the market. Absolutely. I think 2025, we're going to have good movement. Growth, not so much, but yeah, the actual...
He really wants to tell us his 2025 prediction.
No, not yet.
Not yet.
I'll leave that to the end, right?
Not yet. We already started predicting early.
Well, what we had thought with regards to that change was that it wouldn't so much, I don't think it would have, I think what it would affect the most is that from our perspective, what we see a lot of is houses that kind of hinge on that $1 million value.
Yeah.
You'll get a lot of, even in multiple offers, people just are capped at $999, $999 because they can't or don't want to go over the million or up to the million because that changes the down payment requirements. So we think that in some segments and certain situations that may benefit sellers where buyers are now able to spend a little bit more without having the change in down payment.
That's also why the townhouse sector has done very well because it's kind of within that $1 million. It is not as high condo fees. But yeah, jumping into now the 1.5 gets you into like Milton area, stuff like that. It gets you into a single family dwelling. Like it gives you the options, right? It really is going to push that market. I think it's definitely going to help. The difference, though, if like on a calculation in percentages and stuff, we'll go into those numbers. So right now it's about 4.2 times your income.
Affordability.
For affordability, yeah. When you're doing the calculating ratios for the boring stuff and the mortgage, the mortgage stuff in the back end, but the change will bring it up to there's only a 0.3 like times difference. So it brings up to 4.5 times your income from 4.2. It's not a huge jump,
difference.
Right? So you still have to qualify, even though you're allowed to go to that number.
Yeah. So yes, it opens up the doors to especially, I think it's going to really help the new construction part of it, to go to the 30-year amortization from 25. That's definitely going to help. What was that?
I think that
speaker
was
died.
the speaker dying or something.
Oh, okay. I got an email or something.
Yeah.
So it's not a big jump in how much more you can get, but for those that don't have more than 20% down, that wanted to get into that 1.5 million and they have good income, that opens the door for them, right? But realistically, there's not many first-time home buyers that are making, they basically have to have a household income. Oh, do you guess how much it has to be? So let's just say it's 1.5 million. Your minimum down payment now will be $125,000.
Right.
But in order to get that mortgage,
you need like a $350,000 household income.
About 310. That's with little to no a debt, right?
Which is probably more than double the average.
Correct.
Average household income currently in Milton is hovering around 140 something.
Yeah. So that when I look at those numbers,
and it's not that much higher in Oakville, surprisingly. Yeah. And it's Milton is higher than most of the surrounding areas, which is quite interesting to me. But you look at like our buyers from the past, and I know so many of them purchased, $1.5 million homes and only putting 20% down. Mm-hmm. And I'm like, you got a 1.1 or a $1.2 million mortgage? Like, I know you don't make that much money. What are you doing?
Yeah, it's so that's why I think it's not going to make a large dent, like a change in the industry. It's the beginning. I think there's going to be a lot more changes to come. Again, looking at historical, what they've done.
Give us your prediction, Cam. Come on.
Soon.
I think there's a balance too, because they don't, what they're trying to avoid is they don't want to make it overly affordable. They want to drive prices down, because the whole point
have a balance.
Yeah, the whole point to raising the rates and getting inflation in check was they wanted to stop the craziness that was happening. I mean, across various industries, but in real estate in particular, it was just everything's unaffordable. As soon as you start making it too affordable, then you're going to run into that competitive marketplace again. That's going to start driving prices up. So it's kind of like there's got to be a balance somewhere in there between building more homes, increasing supply, and making it a little bit easier for people to get approved within reason.
I do believe that the government definitely has failed in the last little while with how they should have restructured a lot. If you look again historical, the previous government, like the Harper government, they changed things as this is pre the collapse. 2007, they came out with a 40-year amortization. Mm-hmm. The rates were already high. Our rates were actually higher, so they should have done something for the homeowner. They restricted. Years later, they started realizing, people are taking 100-year or 100% loans with 40-year amortization. And it's like they're paying interest only, basically, because the rates were so high. And it was then they started changing things as the scope changed. But what's happened is the last couple of years, all of these changes, the driving of the value of the homes, they didn't restrict. They should have. They should have put the changes in play at the time, like maybe even anything like refinancing. We were able to refinance back in the day to 100%.
Oh, wow.
It was crazy. And then, of course, it would be CMHC, like it would be insured. But then they stopped refinances. So everything's changed. But I find it really odd that they didn't make very many changes in the past little while. The number one thing, though, I do want to press on, no matter how much you change the mortgage rules, how much you do, like, regardless of rates, it's affordability aspect. That's a day-to-day for someone to be part of home ownership. But in order to stop or control or decrease, whatever it be, the value of the property is the amount of new builds that they put out.
Mm-hmm.
And I don't understand to this day. We have the second largest country on the planet, and we have an issue with builds,
right? New
builds, and they say that it's the protected area and stuff like that. But what about other provinces? Put out more permits there. And then people will say, you know what? It's really expensive to live in Toronto. I still work from home. A lot of people still do. That's why a lot of people now are like, a lot of my clients are Canadians and they live down in the U.S. I'm not supposed to say that, but but they work from home
for 5 months and 29 days.
Right. So for them to put out more permits out in Alberta or anywhere else or anything of the sort, like that, they can control the amount of growth on the property based on how many permits they put out. Down in the U.S., they just announced, actually, they put out new builds, or it's up 9%. So what they do is they realize, okay, well, we have to control more, so they put out more permits, and then, hey, if there's too much supply, let's decrease it. Work with the builders. Put out, with every development, don't take a decade or two to put out a development to get it approved. Say, okay, well, we're going to allow you permits for phase 1. Get on with it. Then they review the current market conditions. Okay, values are skyrocketing. Put out 2 more phases. Get going in the larger scale, obviously.
Yeah.
That's ultimately how they're going to control it, but they don't do it. So Mattamy Homes, everybody knows them, especially around here. The guy's owned property for over a decade trying to get site plan approval.
Right.
So where do you think he went when he realized this? Okay, this is taking too long, too much
Building
money.
lots in Florida and Carolinas.
Right. In a year and a half, I think it was about a year and a half to 2.5 years, he was able to he said, screw this. Well, he's still building here, but he started building down in Florida. And he had an entire subdivision approved within a year and a half.
Wow.
Yeah. We're talking like resort looking, with clubhouse and everything. Boom, like build it. So they've got to change how they're doing things here in Canada, and definitely how the government can control growth or decline is going to be based on how many permits they put out.
Well, and now the issue also becomes, once it's permitted, the actual cost of the land, the cost of building, and the affordability that way as well, right? Like, we reviewed a stat, I think it was published in the Globe and Mail a few weeks ago, about the length of time that applications take to be approved. And right now in Milton, it's just over 2 years, and it used to be 10 months as of, I think it was about 5 years ago or so. So in the past 5 years, it's more than doubled the length of time that the application gets reviewed. And you look at, because Milton has, I don't know if the numbers are accurate, but one of the highest new construction numbers in the GTA. And you look at the prices of some of these homes, and it's, they're ridiculous. And that's because there's not a whole lot of competition, right? So to your point, build more homes, supply and demand, drive the prices down a little bit and give more supply to, we recently reviewed all the immigration statistics. Like, there's tons of people moving into this country on top of whoever is living here now. So
it also goes down to just the cost to build.
Right.
It's become very expensive.
Yeah.
I have clients in
$400 a square foot.
Well, I had clients in Puslinch that they severed their lot. We sold off the pre-existing portion, and their plan was to build on the new lot. But between starting the process, selling the house, and starting the process to get permits to build, the price went from like, they were around, I think originally $400 a square foot. It went but something like $700 a square foot to do what they wanted. I think it was $250,000 just to frame the house. So they said, well, screw this. So we sold the lot. And then also just recently, my brother and sister-in-law, they have a lot in Costa Rica that they were really excited to build on. And they just found out that from the last time they got quoted to now, which was, I don't know, course of a few years maybe, the prices went up 40%. So they're not building
in Costa
anymore.
Rica.
Yeah. So I think that's a problem everywhere.
And while to Cam's point, you got all of the North American people moving into other places of the world because of, the ease of working remotely, right?
Well, not only that, it's just the
Tons
cost of living.
Canadians.
I talked about this in the last podcast or one previous, where a guy that we often use for flooring and stairs, that's his specialty. He had several people working for him. They were all Polish. And then during COVID, they all moved home. They said, fuck this, it's too expensive to live here. I don't like everything that's going on. So they retired and moved back home. So
sure, they made enough money in a year or two that
they sold their houses. Exactly.
Yeah.
Well, you've got, like, to my point of, like, I was saying Alberta, but what about out east? You've got, like,
I've been watching Prince Edward Island, just as an example.
Yeah.
Their market has actually taken a bit of a crash.
Yeah.
They have the biggest decrease in home values over the last year. And, we went there for a conference several years ago and got to walk around and know Charlottetown a little bit. And I thought it was just a beautiful place to buy property. And, the people are great. The location is amazing. I mean, obviously you have some differences in the way of life compared to Ontario, but a lot of people always ask for that. I want more land. I don't want to, smell my neighbors in the morning. I want a bigger property.
Yeah.
I want to be close to the ocean.
We have a lot of clients now that are actually buying out east.
Yeah.
And because they know that it's cheaper. And of course, for us having license, we have people within our brokerage that are licensed out that way. So we have to move it over. So
can I actually, let me ask you a question. Because we're big on, if you can't afford to buy where you want to live, rent where you want to live, and buy where you can afford. So as an example, somebody that's in their 20s or 30s that is a first-time home buyer, and they live in Halton region, and they can't afford to purchase property in Halton region, so they rent something. Is there any difference with that individual if they wanted to buy a property, let's say out east in Canada, and getting a mortgage for that property?
Same thing goes for if they live in Toronto, where they have to work. They make great money, and they buy a property out this way.
Yes, that happens
as a rental.
That happens
right?
often.
And yes, it happens all the time. Actually, one of my because we do a lot of mortgages in the US for foreign nationals, they invest. Half of our book are clients that do not own their own property in Canada because they don't have enough money to get into the market here. So it would be the same case of buying out east. It's a lot cheaper entry point.
From an approval standpoint, is there any difference?
No, you're buying it as a rental property. It just has to debt service everything as a rental. So it's no big issue.
So no difference out of province. So if I was buying a rental in Ontario versus Alberta, there's no difference.
No.
Okay.
No, because the lender, you're going to have a small premium on the rate because you're buying a rental property.
Sure.
But it's not significant. But the same rules apply as it doesn't matter what province you're in.
But you can also do longer amortizations. Isn't that still the case? 30 year versus,
well, so you have to, when you're buying a rental property, you have to buy it with 20% down. So in order to make everything debt service, you're generally always going to a 30-year amortization. If you go to 25-year amortization or 20 or even 10 on a rental property, first of all, it's not the best thing to do, but it doesn't change the rate. Nothing changes. Like, so you might as well go to 30, bring it all the way out, because then you have better cash flow, right?
Right. Any tips for first-time home buyers that are in the market, and any tips for investors that are because I think, and you're heavy into this and study it and watch it, so I'll get your opinion, because 2 podcasts ago when we started talking about all these mortgage changes, what I commented on is over the course of the past 2 years, you've probably seen this, a lot of investors divested from their rental properties. They sold them off because they were bleeding too much every month. They were in the red. They couldn't afford it. Their personal finances were strapped, etc. So we saw a lot of investors sell off property. I think they're going to be coming back. We've already started getting some sniffs, and I think that's going to start to increase in 2025. Would you agree?
As long as the rates continue going down, that's ultimately what it is. Because the affordability aspect for a rental property, if it's not servicing, it's just, and yeah, it is true. A lot of investors are selling off. Obviously, they're changing with the capital gains tax, like all the changes with the taxation, which I believe if the government's going to do anything over the next little while, they're actually going to come after second homes and investment properties,
right?
Tax them more, which will push away more of the investor. That's again another prediction I do have, but we'll see how that comes forward. But yeah,
sell my cottage now is what you're saying.
Well, yeah, your capital gains has already gone up, so you're toast, right? So, but I think let's say personally, I think they're going to put like a second home extra tax per year, right? Like a
luxury tax.
Yeah, a luxury tax, a higher property tax. I've been wondering why they haven't done that for a while, because a lot of my clients have like 4 properties.
Yeah,
because they've been doing it for so long. Their net worth has grown, and what do they do with their money? They're buying more investment properties with it, and naturally, it's like if my average client has 2 properties, they're probably going to try to go after that, right? Because that'll also help stall the market a bit too if it starts to go back up. That's one thing that they might end up doing.
Again, with having to balance things, though, is a lot of there's a need for rentals, because I don't think the prices will ever come down to a point where people who are not able to afford there's still going to be a group of people that need rental properties.
Yeah.
So, these investors provide those. So where's the balance where you're going to tax them more? So you're going to pull some out of the market because all of a sudden other investments look more lucrative, but then that's going to potentially drive up the rental market costs, causing issues in that segment because you're now removing inventory from there. So you've got less supply.
You just got to push, again, back to the permits.
Purpose-built rental buildings and stuff like that.
They've got to do more when they're building out infrastructure. They got to understand there's affordable housing. Even you just naturally putting out more permits and keeping the property values from going up as fast. Then over say a decade, your incomes will start to increase and catch back up, because it's so far out of whack right now. The changes, like I was saying, if you're putting down $125,000, if you're making household income $300,000, $320,000, you can finally get that mortgage amount, or the increase, the changes that are happening December 15th. But your monthly payment, that's a heart stopper right there. It's huge money, right? It's and if $1
million now is what, about $7,500 a month, something like that.
The other thing that I've noticed too is the higher income you go, so you're in a different tax bracket. So this thing of taxation, like the more income you make, the higher you get taxed. That's not factored in to the approval.
Right.
The ratios are the ratios. It doesn't matter how much you're making. They don't factor in, you now are making $75,000, so your percentage of your income is changed.
So they're looking at gross.
they're looking at gross. So what ends up happening is you have $300,000. You're now paying 53% or whatever it be. Like, I'm not an accountant, but it's high. It's like 50% of your income is going to taxes. So you're really only making 150 grand. But
if you're self-employed, are you still looking at gross?
No. Well, it's whatever is actually on your notice of assessment. If you're going to the A side, if you're going to the B side of lending, then you can use bank statements. There's different ways of qualifying.
When you say B side, you're talking like credit unions or
credit unions, trust companies. Generally, they're higher interest rates. Sometimes they have fees involved, like lending fees up front in order to close. I actually, on the B side, a lot of the lenders are starting to come back with the 35-year amortization, which I do think that on the A side, they really have to press for that in order to help affordability. Get back into a 40-year amortization, which would be great. But yeah, B side is already starting. They're increasing. They actually had it a couple of years back. They clawed it back, and because of any of the, depending on if you're regulated under the banking laws, they're the ones that had to claw back first. But we're starting to see that's finally coming back into the market, which is good. So
it's interesting. All these things we're talking about, when you post things online about each, I can picture the responses. Like it's quite controversial. Like when it comes to investing in real estate, people say, well, real estate should not be an investment, period. Anything to do with, essential needs. And then there's the extended amortizations. People were like, oh, great. So we're never going to own our home. Just keep paying forever. And, but these things need to happen in order to help people get into owning houses.
I honestly, I think everybody can agree, I'd rather own a house and be paying interest only rather than paying rent. If you can get into home ownership, do it.
Yeah.
It at all costs. It always has, like, historically, actually,
in this country, I mean,
if you look at the difference, and I went to a conference in the US just before I came up here, and the average person again, this is US stats, not Canada, but the average person will retire, if they owned a home, they'll retire with about $580,000 on average of net worth. Where if they're a renter and they rented their entire lives, the average person in the US that retires only has $10,000.
Wow.
Yeah.
That's a huge difference. So
And
clearly it's a nest egg, and get into home ownership. That's what it means.
I would say that's not to say that real estate's the best investment necessarily, because there's a lot of options out there. But I think it is to say that it can be very lucrative. And we've seen that many times over the last decade, certainly. But I think it's that people just are not educated financially, and they don't. So owning a house is kind of like forced savings for retirement, versus when you're renting, it's like, hey, I got $2,000. I got an extra $3,000 to spend each month. I'm going to spend it.
Well, that's it. People like to spend money.
Yeah.
And it is forced savings. Like, if you think about, if you're renting a home, like, look at all these people with all these nice fancy cars that don't own a home, right?
Don't get me started.
Yeah. Well, that happens in the States actually everywhere.
That
right?
is so again, when I got off the plane here at Pearson Airport, I get picked up in what? A Tesla. You're driving an Uber with a Tesla. I guarantee you that guy doesn't own a house. He probably doesn't. Most of the people don't. They don't put their priorities straight. And the first thing that I say to everybody, any of my clients that come to me, and I can have them on the books for years.
Buddy, Tiffany on our team, I don't know how old is Tiffany, 26?
Yeah, something in that range.
Still lives with her parents, drives a Tesla.
Well,
she's not going to get into home ownership.
Well, that's another thing, is people are living at home longer, if not indefinitely.
Yes.
Right.
Yes. Multi-generational homes.
You're going to need a bigger home, bro.
So
I'm okay with that. I mean, that may change when my kids are teenagers, but
when they start bringing
that.
boys home, you're going to want a bigger home.
Again, back to that conference I was down in the US, the average first-time home buyer 10 or 20 years ago was 28. The new stat that just came out is 36.
Ooh,
wow.
The second home is now 58.
Wow.
The second home is the new stat, which is weird. I thought that was really high, but
that is high.
I actually took a picture of it. I didn't
Living
believe
your
it.
first home for 20 years?
It is. Is it?
So we're almost there, but
yeah,
we've been in ours for 14 years almost.
Well, this is our second though.
Oh, true. My bad. Yeah. I may live here forever based on how things are going.
Yeah.
I don't know.
But that's okay. And you paid off your mortgage.
Yeah, that's true.
But it all correlates. Like you've got the average person, their first child, right? They're in their 30s, right?
Yeah.
So everything's shifted up.
But you know what's crazy about that? If you think about the logistics of that time frame, is if you're buying your first home at 36, are you really living with parents or family? No, you're probably moving out and renting something during that course of time, right? In your first 36 years of life.
Yeah.
So now you're renting. How the hell are you saving up your down payment?
I wish I had the stat. I read an article on the weekend and it was talking about that. And it was talking about how the average renter would take something like almost 30 years to save up a down payment.
Yeah.
Based on the average income and the average amount of rent.
Well, this is why I was talking about the early inheritance and gifting from the older generations down, because I think that's going to play a huge factor over the next 5 and 10 years, which is also, if you think about, sorry to be graphic, but people dying, there is an older demographic that owns a lot of real estate and has a lot of equity in that real estate, right? You think about the grandparents that we all have that bought their homes for $100,000 and now it's worth a couple million or whatever.
Yeah.
Like that's 20% of Oakville.
Yeah. Well, you'll probably see like estate taxes and stuff going up too.
Yeah.
Well, they just did, right? Everything's gone up. The government already knows that the largest transfer of wealth is going to happen in the next, I think, 10 to 20 years.
Yeah.
They've already predicted that. That's why their taxes are going up. Your estate tax, capital gains, all that kind of stuff. They're trying to increase taxes because they want that money, right?
We should do a seminar with an accountant, the four of us, and do it on planning for inheritance.
Mm-hmm.
Yeah. Actually, one thing, and I'll quickly add to this. So we do a lot of reverse mortgages. At one point I was one of the highest producers. Now the rates have gone up. So
explain a reverse mortgage.
Okay. Reverse mortgage is basically if you're retired, you're over 55 and you want to take some funds out of your property. You cannot get qualified on the standard way of financing to get money out. You're on CPP, OAS, like your pension, retirement, any form of retirement income, and the money that you want is just not accessible with the standard for ways of getting approved. So as long as you can prove that you can pay your taxes, your property taxes, and you have there is a ratio that's very different than your standard way of financing, then I can provide you up to basically 50% of the value of your property, and you can use that to do whatever you want with it, and you don't have to pay any monthly payments on it, because reverse as being no monthly payments, the mortgage obviously will increase slightly because you're not paying it down or not paying the interest, so it's slowly ballooning into that the property the mortgage on the property. So
you're advancing the equity is really all you're doing, right?
Right. Yeah. So what we're doing is and it's happening a lot, is living inheritance. So it is, if they transfer that out, they refinance, give the child or their grandparent or the grandchildren the money. It's living inheritance. It's actually tax free, and it's a gift to the person that they give it to, so they're not taxed on it, and they take it out of their property. So now it's living inheritance. When they pass and it goes to the estate, that mortgage is registered, so that gets paid out. It's not part of the probate. Right? It readjusts itself, so they save a lot of money for sure, and that's why that's actually a pretty hot thing to do right now. It's everyone's trying to pull money out. Whatever they got, they give it to their son, which of course, if their average age of 38 years old, that's probably around the time frame. Might as well give it to them before you pass on and it gets destroyed by the government and taxed.
Enjoy it
to have
while
a
you
conversation with my parents.
can. Yeah. You don't need money. Come on.
A little more never hurts.
Any final takeaways before we wrap up? You don't want to give us your prediction yet, so I guess we're going to have you back on before the end of the year is up.
Well, I'll give that, I guess. That's not a problem. We'll find out. Okay, final takeaway absolutely is we find this with every file. Do not buy a car until you buy the house. Just buy a cheap beater, whatever it be. Just get to A to B with a cheap vehicle. Don't go out and buy the Tesla. I actually was walking around the mall the other day and I saw that they've got a unit in
Inside.
Sherway with Teslas. I'm like, and it's full. People are just looking at it. It's like, you got to be kidding me. Like, there should be an understanding that if you're going to walk away with a $1,500 a month bill, you're going to really screw your chances of getting home ownership.
Yeah. Well, we talked about the average cost that blew us away. Well, blew Adrian away.
Yeah.
The average cost.
Touch.
How much was it?
Over 60.
$62,000 is the current average price of a car in Canada.
Yeah.
$62,000. So if you think of even leasing that vehicle, well, now you're leasing it at 7 or 8% interest. At a 50% residual value, that leaves you $30,000 at 7 or 8%. So your monthly payment is over $1,000 easily a month.
Yeah. And factoring that in, it's just, it strips you from home ownership. So
don't buy or lease a vehicle. Buy something if you can.
Don't finance
cash.
or lease.
Don't finance or lease. If you can buy something cash, buy something used, just close on the home first and then do whatever the hell you want after.
Maybe ride it out for a year so you understand the cost of home ownership before jumping into
most
a payment.
people won't.
Absolutely. Well, yeah, I know. I always say though, if you can buy 10 cars if you own a home, but you can't buy one home if you own one car and it's financed. Clearly, that's the point.
That's a good clip.
Yeah, there you go.
I've been saying that for years.
That's tip one.
So I guess you guys had me back on here, or had me on here because I remember the podcast. You guys were asking what your predictions were and all that, right?
For the market. Yeah,
for the market. That was what, in January?
December,
yeah.
Yeah, we'll look back year over year and see who was right.
Yeah. Do I get a prize for that?
No.
Whoever's closest?
No. Did you make a prediction? You did. I don't remember what it was.
I said it would decrease by 3%.
Okay.
Yeah, you were decrease. You were flat.
I was flat.
I was increased by 3 to 5%. I said.
So
we're almost there. It'll be interesting to see how it plays out.
It is. I think it's actually going to get a little worse because all these changes are not happening. Actually, so last month when I actually reached out to you and I said we should do a podcast because of what's going on, and it was it decreased. It's a negative by 3.9%. I'm talking all of Ontario. And I reviewed the stats a couple of days ago, and now it's a decrease of 4.4. So it's gone down further. Given all these changes in the market, yes, the rates have gone down, which is a good part of the factor, but like the new mortgage rules, all these changes are not happening till the end of the year. So
well, and we haven't seen any impacts from the current or the previous rate reductions. So I think we'll need to see them almost double in order to see a substantial change.
Yeah, I think it's going to be around, like it's going to stay steady around like the 4% decrease. So by the end of the year.
Going into 2025, though, you're expecting some more activity.
I think the activity, yes. Values, I don't think are going to be jumping all that much.
Interesting.
I for some reason,
I think you're wrong.
Really? You think it's going to go back to crazy?
I don't think it'll go crazy.
Yeah,
not crazy. But I think supply is going to be there for buyers, and the buyers will increase. So I think there will be a balance because there will be more supply, so it won't allow it to go crazy. You know, because when we see those crazy times, it's because there's no supply, right? Mm-hmm. You put an offer on a house, there's 20 other offers because that was your only choice, or you had very limited choices. I think buyers will have more choices. I'm talking about resale market right now, right? But there will be more buyer activity with the rates coming down and whatnot.
Yeah, absolutely. Yeah. There's so many people sitting on the fence right now, right? Waiting for those rates to come down. But, and as you said, they're factoring in the amount of supply. I think there's going to be a lot of movement, but to increase more than 5%, I don't think we're going to see that, just because the affordability aspect is still a hard thing to get over. Like I was saying, that the average mortgage amount was $635,000 for my Oakville property or Oakville location, but you would think it would be way more than that for a mortgage amount, not purchase price, obviously. And the reason why it hasn't continually gone up is because the income has not gone up.
Right.
So that's why it's kind of stalled. So people are putting more money down or getting the bank of mom and dad to help out if they need it. Exactly your point, saying second home. You're getting parents to help put more money down so they can get into that bigger home. So I think, it's going to be around, I'm going to say increase 5%. The other thing that might really help change that prediction is going to be if the government actually gets off their ass and helps an actual person in home, in obtaining a home, like lowering rates is just a small factor. But if you increase to say a 40-year amortization, if they make any changes on the unsecured or the conventional,
which I think rules, we will see it.
I really do think so. I believe it's to go right to 40-year, like the US, we can do 40-year amortization now.
Yeah.
They're way ahead. But personally, I think it's a political stunt, like I was saying. They're waiting closer. They started doing this now, but now that the election's coming up, they're going to change everything and say, hey, I saved the country. Right? That's their last, that's a shot in the dark. But at the end of the day, I think it's a must. So people can afford their house. It's not fair. Like as much as, a loaf of bread is doubled in price, like they've really got to do something with the housing. It's unfortunate, but 5%. That's my prediction
for 2025.
For 25, yeah.
Got it.
There you go. So thanks for joining us. If we'll put your contact details in the YouTube description, but for those that are listening to the podcast, if they want to get a consultation with you and a mortgage pre-approval or approval, refinance, all that stuff, how does somebody, what's the easiest way to get a hold of you?
OntarioLend.ca.
There you go. So go to OntarioLend.ca. We've known Cameron for 8 or 9 years. He does a lot of business with our clients, and somebody that we trust and recommend on a pretty regular basis. And first time on the new podcast, and we'll be happy to have you back and chat to see if your predictions are right.
And to answer your question about is there a prize for being right for the 2024 prediction, there was. I think it was $100 gift card, so big money.
Come on, guys.
And I know you spend a lot of time in the States, so I just want to clarify it's Canadian funds.
Yeah, so that's like $41 right now.
Yes, there is. It's Canadian
All right, guys,
pesos.
nice chatting today.
All right,
good time.
Thanks a lot.
Thanks.
Hope you all enjoyed today's podcast and you learned something new today. Don't forget to hit that subscribe button and like button and follow us for more content, and have a great week. See you next time.